Hello, everyone, and welcome to the MNP Spring 2021 Agricultural Industry Webinar. The past 12 months have been unprecedented in our lifetime. While vaccines for COVID-19 have been developed, inoculations have not been quick enough to stop the third, or is it now the fourth wave, with variants taking control. Let's hope this virus can be tamed soon so that we can put this behind us and resume life as we want it. We also hope that you and your family and colleagues are well and are staying safe. My name is Victor Kruger, and I will again be today's host for this session. I am a Senior Vice President of MNP Ltd, the insolvency and restructuring arm of MNP LLP. MNP LLP is Canada's fifth largest professional services firm with offices across the country. MNP believes in having specialized client service groups that we call niches, each with dedicated employees working in them. This specialization provides our clients and the industry with knowledgeable practitioners. We have identified 16 specific business niches to date. Agriculture is our largest and oldest niche, dating back to 1958 when MNP was established. As the agriculture niche is so large, it is further broken down into sub-niches, including food and manufacturing, intensive livestock, primary producers, hydrites, farm income programs, and cannabis. MNP is also the only professional services firm with a farm management consulting group comprised of professional agrologists and consultants who come from extensive agriculture, farming backgrounds and bring a high level of technical expertise, firsthand knowledge, and close relationships with the agriculture industry to give us a real understanding of the issues faced by today's agriculture industry. The FMC group supports all of our other service lines in any ag-related engagement, and in particular in every agriculture insolvency or restructuring, where they provide us with expert advice to a specific situation and, if necessary, to be hands-on in a formal engagement. Our presenter today is John Lepke from our FMC group out of our Winnipeg office. John is a professional agrologist who has 20 years of experience providing service to the agriculture industry, starting as an ag lender and then as a consultant to the industry. John grew up on a mixed grain and hog farm in southeastern Manitoba and still lends a hand on the farm as needed. Our webinar is again being pre-recorded to allow you to watch it on your time. At the end of the presentation, you will find contact information for both John and myself if you have any questions. We'll respond to your questions as quickly as we can. John, we now look forward to your presentation.
Thanks, Victor. As mentioned, we got lots of things to talk about today and lots that's happened over the last 6 months in various agriculture industries. Here's just an outline of kind of what we're going to be covering today, starting off with just some market fundamentals that we see in agriculture. Obviously you have to talk about the US, one of our largest trading partners, and then we'll kind of run through some of the individual ag industries that we deal with. By no means an exhaustive list, but just some highlights that we're looking at for each of those. So to start things off, we'll kind of talk about some of the market fundamentals that affect agriculture. Obviously, a big one is just supply demand. A general rule of thumb is that demand is fairly constant. It does shift up and down over time, but usually those shifts take a long time to happen. Most of the change that we see is on the supply side. So weather having a big impact on that, usually one of the biggest actually. So whenever we're looking at any of these industries, we're definitely looking at how is supply, how is demand, And you'll see that as we go through some of these, I'll be talking about where demand's at and maybe where supply is at. So, really, when we're talking about agriculture today, it's happening on a global scale. There is some smaller micro markets, I guess, but definitely for the most of the industries we're talking about in Canada, we're looking at global scale. So, events that happen around the world directly impact Canadian farmers. Obviously, the U.S. is one of our biggest trading partners, and you'll hear me talk about the U.S. quite a bit today. And I'm sure you're going, well, we're focused on Canada. Why are we talking about the U.S. so much? And really, that's just because they are, well, they're the gorilla in the room, if you want to call it that. They drive a lot of pricing on a global scale for ag products. And they're also one of our largest trading partners. So, events and things that happen in the U.S. Usually have a direct impact back on Canadian farmers. The other thing that impacts the markets is trade. And I've got in brackets there hoarding, simply because, over the last 12 months, really what we've seen is this idea that countries are really trying to secure their food supply. Early on in the pandemic, I think people were hoarding toilet paper, and much like that, now we're seeing countries starting to hoard food, definitely trying to secure foodstuffs for their populations. And as such, that's kind of shifted the markets and shifted them sometimes in a big way. So kind of, disrupting what you'd normally see on that supply and demand side. Trade is impacting some pricing when we look at that. So, and typically, and we'll talk a little bit more about trade in a few slides, but just a general comment, trade agreements, really the point of those is countries are looking for preferential treatment, or at least a level playing field when they're dealing with other countries. And as mentioned, ag is a global industry. So there's always trade negotiations that are going on with different countries. That being said, everyone's a little bit more focused on COVID these days than trade. Not that it's not important, but definitely has taken a bit of a backseat. So, the other thing that kind of impacts the market fundamentals is supply chain disruptions, right? And so many examples over the last 12 months of how those supply chain disruptions have impacted the markets. A more general example, lately is the Suez Canal. Obviously, seeing that big tanker ship or cargo ship blocking, the trade route, and just the ripple effects of that, and the dollar amounts associated with not being able just to move product, right? So even something as simple as that has shifted markets substantially in certain cases. So, in addition to that, we're seeing, some kill plant closures that have happened over the last year that have really caused markets to swing up and down. And sometimes in uncertain ways, in ways that we didn't actually predict were going to happen. So yeah, as we go through, we'll maybe highlight a few examples of that as well. And we're in Canada, so we do have to talk about supply management when we're talking about the market. A bit of a unique scenario affects, our dairy and our chickens and eggs and turkeys. So we kind of take that supply demand function and we try and match those two in Canada for certain ag industries. So basically we're trying to match, demand for those products with supply. It isn't always exactly precise, but as I mentioned, demand is usually a little bit more static and supply is the one that shifts up and down. So but yeah, definitely something we have to talk about in Canada is supply management when we're talking about the market. It just affects things a little bit differently. Not necessarily looking at, the global market when we're looking at pricing for some of those farm products that are coming off those farms. So as mentioned, U.S. is one of our biggest trading partners. So we always have to keep in mind that our exchange rate with the US is always at the forefront. Depending, if you're importing or exporting, you want this obviously to go one way versus the other. But here's just, the last little bit of history of where the exchange rate's gone. So definitely, I'd say largely Canadian farmers want lower exchange rates that basically boost their income because, as I mentioned, lots of pricing for their products is based off of the U.S. So if we can have a preferential exchange rate with the U.S., that just leads to us having higher prices for our products. So things have trended a certain way, and we could probably talk another hour just on or more just on where the exchange rate's going to go, and is the Canadian dollar really as strong as it is today? Is it supported by all sorts of different fundamentals? But I'll leave that for a different day, I guess, and just leave it that here's kind of how it's impacted Canadian farmers over the last couple of months. So we'll talk about trade a little bit, and we'll start off talking about U.S. and China. Obviously there's been a bit of a trade war going on between the two countries that was started several years ago. And, about a year ago, they reached this phase one deal where, China agreed that they were going to purchase, close to 37 billion of U.S. ag products in the first year. And kind of what we've seen is even during COVID, they've purchased close to that, about 82%. I think if COVID wasn't in the picture, this would be a lot bigger news story. But given that everyone's focused on COVID, trade agreements and how people or countries are actually living up to those agreements has kind of faded off into the background a bit. So again, what's the impact to Canadian farmers? Well, lots of Canadian product flows through the US and then to China. So if there's good trade relationships between the US and China, that just bodes well for Canadian farmers, and obviously vice versa. So as we kind of mentioned there, in general, the trade deals haven't had as much focus just due to the pandemic. And, kind of we're expecting as the world adjusts and gets back to a more normal state, whatever that looks like, we're definitely going to see these trade deals come back to the forefront and definitely come back into focus a bit more. Moving on to Canada and China, diplomatic relationships still are fairly chilly. The Huawei executive and the two Michaels, that story, I guess, continues, and we don't see resolution in the near future anyways. Interestingly, the canola export licenses of two big exporters on the grain side, Richardson and Viterra, they were suspended by China earlier this year, largely we think due to retaliation for that diplomatic piece. And they remain suspended. But that being said, China bought a whole lot of canola from Canada in 2020. So, there we kind of see the political side, and then there's what happens day to day. And certainly they don't seem to be holding back on buying Canadian canola. And in general, the little chart on the right there kind of shows that trade relationships with China seem to have actually improved over the last year rather than decreased. Trade with other countries seems to be declining, both imports and exports, whereas with China, we're seeing growth on both fronts. So even though politically or diplomatically things seem to be not going well on the trade side, we don't see major impact happening there. So moving on. Looking at Canada and US, obviously we've got a new administration in the US. The general expectation is that Biden is going to be a little more level, not necessarily pro or con against Canada, but at least a little less uncertain. which, markets usually like. So we've seen a little bit of that. Obviously, the U.S. is always going to be protectionist, but maybe a little bit less so going forward. So that, that always bodes well for Canada. On the trade front, CUSMA has been ratified a while ago. And I think, kind of the first example that we're seeing of a complaint is due to the dairy side. And so the dairy import quota has come into light that, the U.S. is going, okay, well, you agreed to certain things, and now the devil is kind of in the details, right? You're not living up to the spirit of the agreement. So they've put in a formal complaint last year, and so it'll be interesting to see where this goes. The new Ag Secretary is Tom Vilsack, and he was a big supporter of the U.S. dairy industry in his previous career. So expectations are that isn't going to bode well for dairy farmers in Canada, as he's going to definitely fight hard for the American dairy side of things. So it'll be interesting to see where that one actually lands up. And kind of a new trade agreement that's in process, I guess, is maybe a best way of calling it, is with Brexit. Canada and the UK obviously have to come to some agreement now that they're out of the EU agreements. So we kind of have this transitionary agreement, right? That Canada and Britain have agreed upon right now, and so basically no change from what we've seen in the past, other than going forward, they're going to have to hammer out a new deal between the two countries. So at least temporarily, they have a new deal in place, and we'll see kind of what the impacts of that are as we go forward, as Britain kind of negotiates its way out of the EU and some of those long-lasting ties. Okay, so moving on to the poultry industry. I guess first thing, we're talking about supply managed industries here, so not necessarily impacted as much by what's happening globally, but definitely, there still are some impacts. But more talking about what happens in Canada here. So in general, the outlook for growth is fairly positive going forward. During the last year, we did see obviously some demand taper off, and even the demand was probably just due to supply chains readjusting, and so during that adjustment period, demand kind of went down. But definitely, in general, poultry is the number one protein that Canadians are looking for. There's a fairly aggressive growth strategy from the poultry industry. They want Canadians to eat and cook more poultry going forward. And it certainly seems that Canadians are on that same path, where they definitely want to increase poultry in their diet. If we're talking profitability in general, probably a mix of, improving prices because of that demand and that consumption. And you'll hear me say this a few times, feed costs are really going to be important going forward. So we'll see how that plays out if guys can control their feed costs in that rising feed environment, and how that plays off of the profitability side. So I guess, a little bit back to the trade, is there was some news on that front. But before I get into that, I guess in general, most of the poultry industries are back to filling full quota. As I said, during COVID, demand kind of tapered off a bit, but definitely as of year end 2020, we're seeing all the industries back to getting access to the full market, being able to fill quota, and some optimism that there's growth in the industry going forward. So just looking at some trade compensation for the poultry industry that was announced, as it relates directly to CP, TPP, and the CUSMA trade deals. So the industry is looking for compensation on both of those. However, the Canadian government has announced compensation just for one of them so far, the CPTPP. And so 691 million is kind of what the government's allocated to all the industries. And that's, over a maximum of 10 years, that's going to get paid out. So that kind of covers off your chickens, your eggs, your broiler hatching eggs, and your turkey. So CUSMA, they haven't announced any compensation for that. And I think that's still in negotiations. So industry is kind of waiting to hear what that looks like going forward. One interesting note for poultry and CPTPP is Chile is not in just yet, but once they do ratify it, certainly looks like it's going to have a big impact on the turkey producers. Any trade access that CPTPP had likely is going to be taken up by Chile. So right now, turkey hasn't been affected as much by that trade agreement, but once Chile actually ratifies it, we'll probably see an impact on the turkey industry. Moving on to dairy, I guess before I start talking about dairy going forward, I'll just say, looking back at 2020, probably margins and profitability were pretty, somewhat stressed for dairy. We are seeing, income levels dropping compared to previous years. And so that's putting some stress on some dairy farms, especially guys that were highly leveraged. Obviously, those guys are impacted by dropping margins first. So definitely we're seeing a few more stressors on the dairy industry. That being said, I think we're seeing good consumer demand. It shifted obviously over the last 12 months. I'll call it from commercial to retail. As people worked from home more, were under lockdowns, that sort of thing. How they consume dairy and how they ate obviously changed, and so that had a direct impact on dairy. Interestingly, at the beginning of the pandemic, we actually saw this surge in dairy consumption, and so the industry was actually handing out quota, and literally days later they were pulling it all back as they kind of tried to reassess, whether the actual processors could shift fast enough to change their products from large packaging to small packaging, let's say, as people move from eating in restaurants to eating at home. So we do expect that as we see that shift back, hopefully to people not or people being allowed to go to restaurants and that sort of thing, demand is gonna continue to increase. So again, rising feed costs are going to be a big one. We're definitely going to see, even though top line income might be going up, we expect that rising feed costs are going to kind of take a chunk of that income out, and so it'll be interesting to see kind of what we land up with at the end of the day for dairy profitability. So I'll talk a little bit about how consumer demand has shifted, and then maybe we'll get on to the trade compensation piece after that. So here's just a quick look at some national retail sales and how they've changed during the pandemic. So the first column is kind of pre-pandemic. That's the year-ish ending Feb 1. And you can see that fluid milk demand was kind of down, cream was up a bit, yogurt, ice creams were down, cheese was kind of flat, and butter was definitely surging. Compared to the next 52 weeks ish, ending year end, we're seeing a lot of pluses in that category, right? So people are drinking a lot more fluid milk, creams, yogurts, all those categories were surging. So it kind of remains to be seen if people continue to incorporate more dairy into their diets. Hopefully post-pandemic, and whether dairy has taken a bit of a stronger foothold in people's diets. Definitely butter seems to be the trend, though, that everyone's consuming more butter, no matter where they're kind of consuming it. So looking at some trade compensation, directly relating to CPTPP, the federal government announced a while ago already that they were going to be compensating dairy farmers to the tune of, it's 1.4 billion now that's left to pay out over the next 4 years. And so some of those payments have already started rolling out. I know we're hearing lots of guys that already got payments in January and February. And so annually, the expectation is that they're going to continue to get those payments roughly in the same time frame at the beginning of the calendar year anyways. So, it definitely is helping working capital for those farms, and the intention of getting that money obviously is to compensate them for market loss. So we're really trying to encourage our clients to use it to upgrade their farms, make them more efficient, make them more profitable as we move forward. So again, the government's kind of committed to compensating dairy farmers for CUSMA, but much like the poultry industry, those details are still pending and will remain to be seen how that looks. So moving on to the crop side, very, very interesting. Lots of stuff happening on the crop side. Lots of optimism as we kind of move through this part of the year. So kind of we'll look at some planting intentions first off. Then we'll look at what some farm equipment sales have been, and look at also some farmland values and how those are changing. So to start off with, we'll move on to the planting. As I mentioned before, the U.S. on a global scale really does swing prices to a certain extent. They are a large exporter, so when they have a bumper crop, that definitely impacts world prices, and vice versa when they don't. So again, that's why we're kind of talking about U.S., even though this is a Canadian presentation, is because they kind of drive the market, and so what happens down there directly impacts Canadian farmers. So kind of your three major crops grown down in the U.S. Obviously, lots more, but wheat, corn, soybeans are the ones that we kind of really focus on. Wheat, as it says there, the U.S. farmers are intending anyways to plant a few more acres this year, about 5%. But still, that being said, fourth lowest since a long time ago, 1919. So with the profitability we've seen in corn and soybeans, it really that really is driving U.S. farmers to plant less wheat and more corn and soybeans. So I put stocks in there, ending stocks, just as an indication of kind of how low the shelves are getting, and they're getting pretty low for some of these major crops, and that really is driving pricing through the roof. So some unprecedented pricing that we're seeing for all your major crops, and so a large part of that is driven by the fact that there just isn't a lot left in the bins, right? So when that supply starts getting short, obviously prices start going through the roof. So, and that's kind of what we've seen here. So you can see for wheat, it's down about 7% from last year. So the big crop in the U.S. obviously is corn. We always see corn and soybeans competing for acres depending on what the prices are, and a few other factors, obviously. But yeah, 91.1 million acres is kind of the intention this year for American farmers. Fairly static from last year. But the interesting news is just that the ending stocks for corn are down 3%. So Might not sound like a lot, but definitely is a big impact to the markets and to the industry. And soybeans, I think, is probably the biggest story. 87 million acres. So you're going to see some more soybean acres kind of going in. Hopefully it's going to be one of the biggest crops for the U.S. on record, but definitely as far as seeding goes, it's going to be third largest. And really the big story is that ending soybean stocks are quite low. They're down a third almost from last year. So I don't think we're necessarily going to run out of soybeans. There definitely has been talk about this summer potentially they're not even being soybeans for sale, no matter what the price. I think that might be a little bit alarmist. We'll probably see soybeans out there still, but definitely huge support for prices when we see ending stocks getting that low. So moving on to Canada, a little early on to be talking officially about planning intentions. I guess StatsCan and Ag Canada, their estimates are going to be coming out later in April. We'll kind of talk about moisture across the country next slide. But yeah, a lot kind of is riding on the amount of moisture. To a certain extent, guys have their crop rotations and they have their fertilizer plans. But there is always some last minute changes based on moisture and a few other factors. So, the other big one is fertilizer pricing. It's kind of gone through the roof. So definitely margins are going to be impacted. We're talking about some, really, really high crop prices, likely going to be, profitability is going to be tapered off a bit just because we're seeing abnormally high fertilizer prices as well. So anybody that had the opportunity to pre-buy some of their fertilizer probably is looking in a better situation than guys who are buying their fertilizer just in time when they're seeding. So, I know there are certain guys that did have the opportunity to lock in some good fertilizer prices, so that should bode well for them. We are seeing canola acreage expected to increase significantly across Canada. And so the canola and the soybean market are tied together. They're both playing that oils market. And so as you saw from the previous slide, soybeans are not a lot of soybeans in the bin right now, which is driving prices quite high. And so that in turn has driven canola prices up. And so that's giving the market signal to farmers that they should be planting a lot of canola. And it certainly seems like that's the case. So, and a little bit, if I guess I should talk about why are some of these ending stocks so low? We really have seen China buying up a lot of different major crops, and since China is such a powerhouse, they really can swing the market, and that's what we've seen is they've depleted some of the world supplies, and it really is supporting strong pricing going forward. Once we get into the hog sector a little bit later on, we can talk about, why is the Chinese demand as high as it is. So here's, as of March 31st, here's just a snapshot of kind of where soil moisture was at. And obviously it's a drought monitor. So that's unfortunately not necessarily good for Canadian farmers, but you can see, there's lots of yellows and some reds on this map, which means that, across Canada that we're seeing some pretty dry soil conditions. And winter definitely hasn't seen a lot of moisture adding to that. So definitely when farmers are going into the spring plant here, this is something kind of on the top of their mind, right? We've been having conversations where, you can lock in canola at over $14 a bushel off the combine for fall. And so guys are tempted to do that because number one, it's a good price. You're definitely locking in some profitability there. So you're kind of taking that price risk off the table. What you are doing though, is you have to look at production risk. right? Can you actually produce that crop? And this is what's kind of keeping guys up at night, is they're seeing low soil moisture, which gives them pause. Can they actually produce the crop? So yeah, one of those where prices are very favorable. Remains to be seen kind of what crop yields look like, and if they can take full advantage of some of those higher prices. So when we're talking about machinery, I always say that equipment purchases you're kind of measuring the pulse of farmers. As farmers feel more confident in their business or less confident, some of the first things they do is replace equipment or hold on to it and repair equipment, right? So this, for us anyways, usually is a good indication of kind of farmer sentiment, if you want to call it that. Are they feeling like they're going to be profitable going forward, or are they going to be more cautious? And as you can see, obviously, based on equipment sales, they're definitely feeling like they're going to be profitable. So yeah, two-wheel drive tractor sales are up, along with four-wheel drive and combine sales year over year anyways. So probably not hard to say that it's really buoyed by some of these really high crop prices. So so that's leading guys to probably replace equipment that maybe they haven't in the past, or replace it on a faster rotation than they have. So, and I'll just make the comment that, when we do see crop prices this high, and guys are looking at being profitable, this is probably where we see mistakes made more often than not. It's not when guys are having really tight profitability and they know that they gotta watch their pennies. This is where mistakes happen, right? Where you kind of get yourself into some scenarios where maybe you over leverage yourself a bit, and it works, let's say for the next 12, 18 months when crop prices are good, but then all of a sudden, your profitability drops after that, and you're stuck with some of these large equipment payments. So really, yeah, we really feel guys have to be cautious around this time, because this is when we always see some of those mistakes happen where guys get a little too ambitious and start, adding to their debt maybe a little too aggressively. So that being said, we are seeing land values continue to climb. Here's, just a quick graph for some prairie provinces over the last couple of years. And that trend has continued into 2020. So we're seeing land prices kind of continue on that same trend. And so borrowing power to a certain extent is increasing for farmers. And so that could or could not, I guess, cover up some of the sins from equipment purchases. So in general, we're seeing farmland values up 5.4% in 2020, a little bit more than last year, which was at 5.2%. Again, this is based off of the FCC data that we get. The largest increases we're seeing in BC at 8%, and Quebec at just over 7%, and Alberta on the prairies, saw an increase of 6%. So kind of similar to equipment, when we see good crop income, yields and prices combined, that kind of drives land prices on an accelerated basis. And of course, interest rates have a big impact, because we don't see guys typically paying cash for land. It usually is financed. So, and in today's, extremely low interest rate environment, coupled with obviously a really good outlook for crops, not surprised if we're going to see farmland values jump again going forward into 2021. So moving on to hogs, it's been a bit of a roller coaster ride for hogs in the last year. We saw at times during the pandemic when guys could hardly give pigs away. They did almost go, I think they did actually go negative there for a while. So so there was some times for some hog producers that were quite stressful. And so since then, I guess, we got the benefit of time on our side looking back. Yeah, Hogs had a fairly decent year in 2020. So even though there was some lows during the summer, they did really rally and continue to see some strong prices. In fact, we're getting close to some 5-year highs. So, feed prices, as mentioned with all the other ones, they're rising. And so it'll be interesting to see kind of how that plays out. Obviously, we're still seeing good margins for hogs, but being tempered a bit by feed prices. And so part of what's happening is China is shifting its hog production. And it kind of ties in with African swine fever. As China's gone through that, what they've found is they need obviously to do a better job of biosecurity. And part of that is that they've really been encouraging their farmers to stop what they call swill feeding. So feeding table scraps and that sort of thing. What they found was that was a big vector of transmitting African swine fever from one farm to the next. So in order to combat that, they've really encouraged their farmers to move to more, I'll call it North American traditional feeding systems. And they've also started to adopt, and not that they haven't adopted, but in a larger scale adopt larger confined feeding operations for hogs. So the impact of all of that is that they're starting to feed more like we do in North America, which is feeding a lot more corn and soybeans. So that's part of what's driving them to purchase so much corn and beans, is to feed their hogs as they kind of shift their production systems. And so interesting just to see that impact. And obviously, African swine fever still on the radar. They're starting to see a resurgence again. There's kind of new mutant strains that are harder to detect. And so that kind of seems to still be a battle or a struggle for them. And the rest of the world is kind of looking at it because if all of a sudden, ASF would get to North America, that's really a killer for the industry. So lots of talk at the industry level of contingency plans and obviously how to keep that out of Canada, out of the US. And just a quick note on some risk management programs. This is just in general, but definitely I put it in here because it applies a lot to grain guys and to hog guys. Earlier parts of the year, as I mentioned, hog farms were kind of hit by some extremely low prices. And the industry was lobbying the government for, $20 a head, support during that time. And talks had been going on for a while already, but I think maybe sped up due to that. And so just recently, March 25th, 2021, there's been some changes to the Agri Stability Program and changes for the better. So it's giving guys a bit more access to that Ag Stability Program in that they trigger a payment earlier than they would have in the past. So, and that's reflected in changing their reference margin limits. So, so good news, I think. I think the industry wanted a little bit more, but one step at a time. This is kind of where we're at today. So, so that Ag Stability change going to be retroactive to 2020 and going forward. So moving on to cow-calf, definitely, we're seeing prices strengthening, or I think they've been fairly stable, but gaining a little bit of ground on the cow-calf side. At this point, calves are actually probably more valued than backgrounders. If you're looking at the margins on holding some of your calves back, and I'll talk about it a bit next in the next slide, but it kind of trickles back to the cow calf in that we had this feedlot backlog and there still is a bit of that going on. So guys are trying to slow the system down, and slow that supply chain down. And so that's why calves are seeing a bit more value today than the older animals. So yeah, obviously grass is a big function for cow calf guys. And as you've seen in the previous slide, drought is a major concern. So obviously grass quality is going to be, a big one going forward this year, really because it affects, your cows and obviously your weaning weights come the fall. So I think, yeah, a lot will be riding on that. But for the meantime, anyways, it's nice to see that prices are where they are. And, maybe a little more detail on that price. But here's just a slide from CanFax that kind of shows you where 2020 was with pricing. And that's the blue line there. That's kind of compared to the 5-year average, kind of hovering around that 5-year average. But definitely 2021, now we're seeing some stronger pricing as we're kind of getting above that 5-year average and above where we were last year. So kind of following the same trend, but just ticking up a little bit. And obviously much higher than the 10-year average that's outlined in the black line there. Moving on to feedlots, cattle on feed, a bit lower than the same time last year, but still probably 6% higher than what we're seeing average. And a lot of that is just, there's still that backlog due to those plant closures that happened earlier in the year. And so, yeah, cattle on feed there is kind of just patiently waiting for the plants to process and catch up, and they can only work so fast. Definitely, with labor being an issue and obviously new COVID protocols in the plants, that's kind of slowed their productivity down, and then that's kind of backlogged into the feedlots. So kind of that whole system is adjusting to COVID, and we're still seeing some of the effects of that. And obviously, feed prices affecting those feedlots as well. And so just like the other industries, just something to be aware of as we go forward. So moving on to wineries, probably for the industry, I'd break it down into 3 sort of segments. You kind of have your large wineries, your craft wineries, and then your contract growers. And so COVID's impacted, each of those differently, and the outlook is probably a bit different for each of them going forward. Those larger wineries have held up a bit better, largely rely on wine sales for income. So you can imagine that's been quite good with people under lockdown and such around the world. They also purchase their raw materials, some of their grapes from around the world as well. So that allows them to manage their cost of production to a certain extent. And so that industry, I think, or that section has fared fairly well. On the other hand, that craft winery section, I'll call it, they're struggling a bit more. They don't rely as much on, wine sales obviously are part of it, but they also usually have some sort of tourism piece as part of their income stream as well. And so obviously lockdowns have affected that. And as we continue to see those rolling lockdowns, and I think Victor mentioned, maybe, are we in the third wave or fourth wave? That's only going to continue to impact those guys even more. So, and then that last segment, those contract growers, a lot of times they're selling up to the craft winery section. And so obviously as those guys struggle, that flows down to them as well. And so we're seeing some impacts from there as well. So depending on what kind of section you're in this industry, the outlook is I guess steady as she goes, or maybe not quite as rosy. So moving on to cannabis, really when we're looking at this industry, I think we're really seeing this industry go through that whole commoditization process. There was lots of optimism, obviously initially, and lots of hope that it was going to take off. So, I think there was some speculation in the market, if I can call it that, and so there was lots of investment made based on that speculation. That was at that point still unproven, and so we're continuing to see kind of the impacts of that. So, retail sales are increasing. They're changing price points to a certain extent. I think most of the companies are realizing that it's a segmented market. Some users are looking more for low cost. Others are looking for high quality, right? So that's a bit of a change that some of the companies are going through. I think more retail stores are opening across Canada. So, I'm sure for this industry, they'd like to see that accelerated. But in areas where that's regulated by the government, that just takes a certain amount of time for them to allow them to open more stores. So, but definitely as we're seeing more stores open, retail sales are increasing in steps. So, we have seen some growing facilities, slowed down or even shuttered. So really, again, based on maybe some early speculatory estimates, the industry thought they needed more cultivation capacity. But as that demand hasn't materialized just yet, they're having to shutter some of those facilities just because there's no demand at this point anyway. So, but definitely, like I said, they're going through a commoditization period. So everyone's driving for the lowest cost of production at this point. I think everyone's realizing there is an upper limit on I guess sales and price points. So in order to stay in business, they're just having to reduce cost of production as low as they can. And we've seen that in traditional ag industries, obviously for decades. So no surprise that they're kind of going through that. But interestingly, now they're looking at what the potential might be in outdoor growth versus indoor, and obviously that's driven by just trying to lower the cost of production. So interesting to see where that one will go. Moving on to food and beverage. I think in general, sales have increased for the sector, by about 3.5% over the year. So that's bode well for them. And food and beverage and other industries, labor shortages kind of continue. If we're looking at packing plants for beef and hogs, I think we'd probably say the same thing for those guys. They're kind of battling to a certain extent with some government programs at this point that are keeping people at home versus going back to work. So definitely we're seeing some labor shortages from that standpoint. Temporary foreign workers are also one that always is a struggle. But during COVID, those costs are even higher. And so labor shortages are just kind of exacerbated by that. So, again, demand, we're expecting it to shift back to food service and away from grocery. But, at this point, it's still strongly in that grocery standpoint. And hopefully we get back to a point where we see that balance between food service and grocery. And obviously the supply chains are going to have to kind of flip back and revert once we see that change happening. So that's the end of my presentation. Back to you, Victor.
Thank you, John, and thanks again for another insightful presentation. It's amazing the changes that can happen in a 6-month period in this industry. We would like to thank everyone for participating in this webinar, and would encourage you to contact John directly or any of our other FMC practitioners with any specific agriculture questions you may have. Any insolvency related questions should be directed to me or any of our insolvency members across the country. And attached to this presentation, the appendix includes further information about MNP and our Farm Management Consulting Group. This webinar has been recorded and sent to all of you as you have requested to be added to our Ag webinar distribution list, and it also will be posted to our website at mnpdebt.ca. Please feel free to forward the link to the presentation to your colleagues and encourage them to contact me directly should they wish to be added to the distribution list. We look forward to your participation at our fall 2021 webinar, when hopefully all Canadians have been vaccinated, and look forward to hearing from you with any questions or comments you may have. Stay safe and goodbye.